Hello and a very warm welcome to all of you for day 2 of the 5th Dvara Research Conference. I am Rakshit Ponnatpur. I work as a research associate with the household finance practice at Dvara Research, and I shall be today's host for the conference. Yesterday, we flagged off this conference by discussing two papers on perhaps the most pressing issue of the times we live in. The financial conditions of migrant households. Research teams from LEAD at Kriya University and Grameen Foundation presented their papers and received valuable feedback from the panelists and answered some of the questions the audience had for them. We also heard two noted scholars from the field, Mr. Timothy Upton, as well as Professor Jonathan Murdoch, talk about the papers as well as their overall comments about the contemporary status and challenges of household finance and its role in the larger context of improving the financial lives of low-income households. Two of the overarching takeaways from yesterday for us was one, a greater need for researchers and, more importantly, financial service providers to understand the goals and priorities of low-income households, and then focus more on aligning their products towards these goals rather than the other way around. And two, better suitability of high-frequency studies for articulating the financial problems of low-income households more than, say, annualized studies, which are more suitable for households with more stable incomes. So those were the key takeaways from yesterday. Today, we are shifting our focus slightly on another important theme, perhaps what forms the very core of household finance research, that is that of household portfolios. The focus of today's papers and discussions shall specifically be on Indian households and the salient features of their financial portfolios. How households here, the low-income ones in particular, perceive and utilize gold, how their behaviors and coping mechanisms to shocks, such as health emergencies, differ based on their existing portfolios, which are the different social, economic, and demographic factors that influence their financial decisions, etc. Between them, the papers and the discussion promise to cover a large area of research under this theme and add substantially to the existing body of literature. So before we begin with the first segment that we have for today, a couple of points for the panelists as well as the attendees. So the attendees are watching this conference through a separate live streaming link on the website. That is why you don't find them here on the call. But they have an option of sending questions to the panelists as well as presenters through the chat box, and we will share that with you during the Q&A session. And for attendees, kindly please drop your questions on the right-hand side, the chat box that is there on the right-hand side. And the speakers will take this up during the Q&A session. It would be great if you can also attach your questions with your name so that it will be easier for us to curate. With that said, let's start with the first segment, with the first presentation. We have the team of Professor Renuka Sane, who is an associate professor at NIPFP, and Mr. Manish Singh, who is an assistant professor at the Department of Management Studies in IIT Delhi. They are going to present their paper titled Understanding Gold as an Asset Class in India. Since the title is pretty self-explanatory, without wasting further time, I shall hand over the floor to the team to take us through what looks like an exciting piece of work. All yours, Renuka and Manish.
Hi, Rakshit, can you hear me?
Yes, I can hear you.
Okay, can you see the presentation?
Yes.
Okay, so how much time do I have?
You have 30 minutes for the presentation. The Q&A can be done after all the three presentations. So you have 30 minutes for the presentation.
Okay, thanks. So good evening, everyone. This is a joint work with Professor Renuka Sane from NIPFP, and this is Manish from IIT Delhi. The basic question which we wanted to answer is, why do Indian households invest in gold? Title is pretty self-explanatory. And as we progress, I'll let you know what all we cover. Okay, so India is one of the largest consumers of gold. We consume around 25% of the total gold production. But in terms of supply of gold, we hardly produce 0.05% of the entire world supply. This is also a very significant portion of Indian households' portfolio. In a very recent RBI report, we saw that this is actually gold ranks second after the real estate in terms of total household investment. Indian government has also worried time and again about households' investment in gold. It seems like huge amount of foreign exchange reserves of Indian people are drained in buying gold. So we wanted to understand what basically explains this love for gold for an Indian household. Now, the one side of the story is the access to credit story, where gold provides easy access to credit. It has huge cultural significance in Indian diaspora. Women use it as a jewelry. A lot of people think that because we have huge financial literacy, this might be another reason why people invest a lot in gold. And then people who are financially literate, they might use it for tax avoidance or other purposes. We actually take slightly different approach, and we try to understand gold as an investment asset. So we raise this question, like, is it actually true that gold gives or makes economic sense as an asset? Okay. And we check the property of gold in that regard. Now, before going to the details, let me just set the broader context within which this study was built. So in India, we are living in a very high and volatile inflationary environment for a really long time. So before 2016, we were not targeting inflation, and inflation varied anything between 5 to 12 or 13%. After 2016, we have targeted inflation, and now we are talking about inflation, which is 4% plus minus 2%. But it seems like 2-3 years down the line, even targeting that inflation seems difficult. Also, we have an environment where the typical investment which is available to an Indian household, which is the fixed deposit or insurance, they offer zero real return, or in most cases, they actually offer negative real return. If you classify in a higher tax bracket, this is even exaggerated for you. We also do not have access to foreign international markets, so there are huge restrictions, and Indians don't have access to invest in S&P 500 and things like that. This has changed. So in the last 20 years, the course of time, it has changed. But still, most people in India do not invest in international financial market. I mean, given this macroeconomic environment, if gold can offer real rate of returns to Indian households, or if it can work as a hedge or a safe haven against domestic equity market, or if it can be a hedge against currency risk, then it makes sense for Indian households to make investment in gold. I mean, this paper, we actually test all these three roles for gold, and we look at the portfolio implications of holding gold. In terms of data, we use gold price data, which we collect from gold fixing price 10:30 a.m. fix from London. We could have used the physical gold price in India or the ETF prices, which are traded in NSE. But actually, the physical gold prices in India starts from 2004, and the ETF prices starts trading from 2007 onwards. So in order to extend the time series, we looked at the gold AM fix, which is the price of gold in US dollar in the LBM market. This also makes sense because most of the ETFs traded in India also track gold AM fixed prices at London. These prices are quoted in US dollar, and in order to convert them into INR, we use the INR USD exchange rate, which is provided by the St. Louis Fed. Both these data goes a really long period back. So this starts from 1968, the gold London price data, and the INR USD rate starts from 1973. To do the robustness, we also do similar exercises using the domestic gold prices, so physical prices as well as the gold ETF prices. And qualitatively, our results does not change much. Quantitatively, because the sample period becomes shorter, we do find some differences in quantitative measures. To go for the global market indices, we use the S&P 500 total returns index. For the domestic equity market, we use the Nifty total returns index. To gauge inflation, we use the consumer price index with the base year 2012. If you look plain simply at the summary stats of these indicators, you will find that in general, Nifty on average provides higher return, but it also has higher standard deviation. It also shows extreme negative and extreme positive returns if compared to other asset classes. After that, you can see that the SPX is also relatively more volatile, but the volatility is at par with what you observe in the gold market as well. INR USD shows the least variation and least deviation in terms of means as well as for standard deviation. And we find reasonably low volatility for inflation as well. So in the first part, we basically check at the performance of gold with inflation. So this is a plot where I plot the consumer price index for India versus the gold price in Indian rupees. As you can see, when the CPI rises, on average, you see that the gold prices in India rises. Obviously, there are swings around the trend line, but these swings are relatively on the positive side. And if you look at the scale, so CPI here varies from 37 to something like 160. On the other hand, the gold prices goes from around 5,000 to up to 50,000. So the scale says that, in general, the gold prices are responding more than the change in the consumer price index. If nominal prices are not sufficient, then we look at the real price of gold. And one way to measure the real price of gold is to look at the price of gold in terms of consumption basket. So what we do is we divide the nominal price of gold with the CPI to figure out in terms of baskets of gold, is gold giving reasonable returns. You can see that from 2000 to almost 2013, consistently gold prices have given real returns, even in terms of, even when we control for the CPI. After that, there are, you saw a dip, but recently they have all recovered. On average, I can still say that gold prices are holding their value in terms of consumption basket. Now, also noticeable is the fact that these real returns on gold are fluctuating, so they are not continuously rising series. This means even if they are holding the real value, they are still not a short-term hedge against CPI. So in the short term, you might observe the nominal price of gold not in line with what you see in CPI. If you move to the longer run, and if you look at 10 years inflation with 10-year nominal gold returns and 10-year real gold returns, then you will always find that nominal gold return for a longer period of 10 years has beaten inflation consistently. So in this graph, the red line plots the 10-year nominal returns on gold, and the black line plots the 10-year CPI inflation rate. Both are at an annualized rate. And this blue dotted line plots the real gold return. So the real gold return is always above zero. And by definition, real gold return is actually nominal gold return minus the CPI inflation. So this is the only point where you see 10-year nominal gold return lower than the 10-year CPI inflation rate. Otherwise, throughout the period, we find the real gold return to be higher than zero. The organic way to look at this is if you think about gold as stock and you think about earnings ratio and things like that, then people can argue that if today the real price of gold is higher, then in future the returns of gold is going to be lower and it might not provide a real return. So to control for that, what we do is we plot initial real price of gold and the subsequent 10 years of real return. So I'm standing in 1999 and I see that the gold price is very, very high, or gold price is high, CPI is low. So this is why gold is overvalued at this point in time. And I look that in the next 10 years, what happens to return. When we do that, even in that case, we find that irrespective of how high the initial real gold prices are, you still get real returns which are higher than zero in almost all cases except one. Now just note that we have data running from June 1999 to March 2021. That's like 21 and a half years of data. So this period which we are talking about is actually 11 and a half years of data. Now, most of the people who do research in this area, they look at a long time series for 35 years up to 900 years. So in India, we don't have access to those kind of data. So this is a preliminary study. And as we have more and more data, we will extend it in future. So what are our findings so far? Is gold a hedge against inflation? On average, we do find that the higher the level of CPI, the higher is the price of gold. But prices of gold do swing around CPI. This means they are not a short-term continuous hedge. If you look at the longer time period, we do find gold as a very effective long-term inflation hedge. And here I am defining long-term as 10 years and above. In the second part, we look at gold versus equity. This is a simple graph where I plot the evolution of price of gold with Nifty and SPX. As you can see, Nifty has outperformed almost most indices. In certain time periods, you do see gold performing at par with Nifty, but in most cases, Nifty has actually performed better than gold. Now to check whether gold is a hedge against domestic equity market, we define hedge as an asset that is negatively correlated or uncorrelated with another asset of portfolio on average. So in this case, if gold is negatively correlated with Nifty, then it is a strong hedge. If it's uncorrelated with Nifty, then we call it a weak hedge. And the way we are going to measure it is we are going to run this regression. So the returns on gold is alpha plus beta times returns on Nifty. And if the coefficient beta is negative and statistically significant, we read this as a strong hedge. If beta is 0, then we'll read gold as a weak hedge. Since most of the returns series show heteroscedasticity, we are going to control for that using the Garch-Wilman specification for the error term. We also wanted to check whether this hedge property is consistent over time. So we split the data sample into the last 5 years, last 10 years, last 15 years, last 20 years, and throughout the period. And this is the results. We find that consistently, it doesn't matter the period. We find Nifty to be a strong hedge. Sorry, we find gold to be a strong hedge against Nifty. You can see the coefficient in the first column, which is using daily data. It is always significant, and it varies in a range from 0.06 to 0.13. When we do the same analysis using weekly, fortnightly, or monthly returns data, on weekly, we do find results, not for the last 5 years, but rest of the period. For fortnightly or monthly periods, we do not find gold as a hedge. Is gold a safe haven? To test the safe haven properties, we first define safe haven. For us, the safe haven is defined as an asset that is negatively correlated or uncorrelated with an asset when the asset moves to its extreme. So when basically Nifty goes to its bottom 1 percentile, bottom 5 percentile, or bottom 10 percentile, do gold returns show a different beta? So here we define beta to be time varying, and it is defined as gamma naught plus gamma 1 times a dummy. This dummy stands is equal to 1 if Nifty returns are in the bottom 10 percentile. Similarly, gamma 2 times another dummy, which accounts for if Nifty goes to the bottom 5 percentile, and gamma 3 and D1. How to read these results? So if gamma naught is negatively significant, then gold is a strong hedge, which is similar to what the argument we made for hedge properties of gold. If gamma naught is 0, then it's a weak hedge. On the other hand, if gamma 1, gamma 2, or gamma 3, any one of them is significant, then we interpret gold as a gold exhibiting a safe haven property. If it's negative and statistically significant, we read it as a strong safe haven. If it's 0, then we read it as a weak safe haven. Now, the first part of this table shows the results when we look at the extreme Nifty returns. So the dummies are constructed based on the returns on Nifty. And we do find for the daily returns that gamma naught is negative and statistically significant, which means gold is a hedge. We also find gamma 3 as negatively and statistically significant, which means when Nifty goes in the bottom 1 percentile, we do find a very different relationship between gold and Nifty, suggesting that gold works as a strong safe haven for Nifty. When we run for weekly, fortnightly, and monthly returns data, we do not find any result. There's a debate in the literature whether for how long a safe haven will property hold. So it can hold for a day, or it can hold up to a month, or 3 months, 6 months. And in most of the literature, people say that for the longest, it can hold up to fortnightly data. So as long as it holds for daily, you can interpret as a strong hedge. So you don't have to go for a longer period. But just for the sake of completion, we show our results. Alternate way to control for these dummies is if we think about extreme Nifty volatility, and we create dummies based on these extremes. And in that case also, we do find evidence that Nifty gold works as a safe haven against Nifty. So our finding so far is gold is a strong hedge against Nifty using daily returns data. And in the last 10 years, this relationship has become even stronger. But if you look at the fortnightly and monthly frequency, we do not get statistically significant results. In terms of safe haven, for daily returns, we do find gold to be a safe haven against Nifty. But for longer holding periods, we don't find it. We move to the third part, which is gold versus exchange rate. In the first graph, I plot the real price of gold versus real price of dollar. The real price of gold is real nominal price of gold divided with the inflation, with the CPI, and the real price of dollar is basically exchange rate divided with the CPI. You can see that over time, the gold is holding its real price, but the dollar value has actually depreciated over time. To understand gold as a hedge against currency, we run a regression where we regress gold returns on change in exchange rate. And we do find positive and statistically significant results for different return series. So if we do it for daily, weekly, fortnightly, or monthly, in all cases, we do find positive and significant results. This means gold actually works as a hedge against exchange rate depreciations. So the way to read these results is basically if exchange rate depreciates by 10%, the gold return will be up by 4.2 percentage points. But you should also note that the R square is very low, which means exchange rate is not the only variable which is explaining the movement in the gold returns. Also note that on average, these coefficients are statistically different from 0, but they're also statistically different from 1, which suggests that gold is a strong hedge, but gold is not a perfect hedge against the currency. If we summarize all these results so far, then gold has consistently weakened inflation, and it has provided real returns for longer holding periods. It's a hedge and a safe haven against domestic equity market, and gold is a strong hedge against currency. If it holds all these properties, which gold does not hold in international markets, then gold is a useful asset class for the Indian households. It also becomes very useful given the India's financial and macroeconomic environment. Now, if we take this input and go into the portfolio implication of this, we answer the question, how much weight should gold have in an Indian household's portfolio? To do this, we run a very simple mean variance market portfolio optimization exercise and try to figure out what should be an optimal weight of gold, as well as for a domestic equity index for given target returns. We also measure the SARP ratio in order to understand the risk of the portfolio. This exercise is relatively limited because our data series is short and we are using historical variance covariance matrix. But whatever we have, this is what we get. So for annual target returns of around 13.31%, we find that the weight of gold in a household portfolio should be around 62.8%, and the weight of Nifty in the household portfolio should be around 37.2%. As you keep increasing the annual returns, so basically look at the last column, and if you go from the top to bottom, the annual target returns goes up from 13.31 to 13.59 up to 14.73. As you keep on increasing the annual target returns, the weight of gold in the household portfolio goes up from 62, so goes down from 62.8% to 52.1 to 40.1 up to 4.1%. On the other hand, the weight of Nifty keeps on increasing, and it goes from 37 to 47% to 59% up to 96%. But if you actually read the tables carefully, you see that the annual target returns hasn't gone much. It's gone up from 13.31% to 14.73%. But the weight of gold has gone down drastically from 62.8 to 4.1. You can read like other ways that the weight of Nifty has gone up drastically from 37 to 96%. If you look at the SARP ratio, you can also see that the risk of the portfolio has increased as you move down in the stack. Now, what this suggests, basically this suggests that even if Indian households hold disproportionately large amount of their asset in gold, the average returns which they are getting is not really low. So even if they have more than 50% of their portfolio invested in gold, their average returns will be around 13%. Also, if I put another asset class, which is SPX, in this, the global minimum variance portfolio will suggest the weight of the gold going down to 46% and the weight of SPX coming in as 22.52%. So basically, SPX is going to take the weight from gold and not from Nifty. Now, this suggests that limited access to gold global portfolio for Indian household has serious risk implications for Indian household investors. So to conclude, given the high and volatile inflationary environment in India, which is marked with financial repressions, where people have limited access to assets which gives real return, and limited access to international market, given the capital control, gold actually has consistently provided real returns for long holding periods. It has also worked well for Indian people who have invested in equity market as a hedge or a safe haven against extreme fluctuation in the equity market. This will also work well as a hedge against currency movement. And if we look at the portfolio implication of holding gold, and even large holding of gold will still provide a comparable returns at lower risk. Given these findings, in our opinion, together these are sufficient economic rationale for why Indian people or Indian households do invest in. So, yeah, that's all. from my side. Thank you.
Thank you, Anish, for a great presentation. You also finished right on time, so the presentation was very well made, and it covered all the overarching literature that exists on gold and the functions of gold. So we'll take the questions later, actually, after all the three presentations. If there are any questions from the panelists, from the attendees, you'll get to answer them at the end of the three presentations. So now that the first presentation is over, we are moving on to the next presentation. Next up, we are going to shift our focus to a very interesting topic where the team of Dr. Debashish Rooj and Dr. Reshmi Sengupta, associate and assistant professors, respectively, at Flame University, is going to discuss their paper titled Household Portfolio Choice and Healthcare Seeking Behavior, an empirical analysis focusing on women in their reproductive age in India. Over to you, Debashish, for the presentation.
Yeah, hi, Rakshit. So I think my presentation is visible, right?
Yes.
Okay, thanks. So thank you, Rakshit, and thanks to Dvara for providing us with this opportunity. So this is, as Rakshit mentioned, this is a joint work by Reshmi. So actually, it's her paper, and I'm just providing assistance with respect to the empirical, but I'm just presenting on her behalf today. Okay, so I'm just my bandwidth is not very strong, so let me close my camera. Okay, so okay, so the topic of our presentation today is savings portfolio choice and healthcare seeking behavior of women in their reproductive age in India. So what we are trying to do in this paper is we try to see the implications of financial savings and as well as portfolio diversification on some of the important health care practices by this group of population in India. So the motivation behind is this research is that we all know that financial barriers in low and middle income countries prevent many women from accessing healthcare during their pregnancy and delivery. Although government in India has taken up several initiatives, for example, Janani Suraksha Yojana, Pradhan Mantri Surakshit Matritva Abhijan, to support this group of women for safe motherhood, but healthcare utilization is still low across several parameters. For example, according to NFHS 4, only 58.6% women accessed ANC during their first trimester. Almost 17% didn't opt for institutional delivery. Only 21% received full ANC during their pregnancy. And nearly 62% received postnatal care after 2 days of delivery, right? So 38% didn't receive any kind of postnatal care. And we know that the pregnant women are the most vulnerable group because they have low insurance coverage, health insurance coverage. They are also likely to face substantial financial burden because of several hidden costs, such as transportation cost, opportunity cost of their time, user fees. And even with the social protections, some of the social protections that we have mentioned, sometimes these social protections may not be able to cover the cost, and the cost associated with the pregnancy might be a little higher. And in these circumstances, health insurance can play an important role. But again, as I have mentioned, the role of the penetration of health insurance in India is especially low. So under such circumstances, prudent savings decisions may help household the building up the economic resources to mitigate some of these challenges, and so that they do not incur any catastrophic health expenditure, and there is mothers get the timely care, and that reduces infant mortality and morbidity. In India, the other challenge with the health insurance is that even though there are a lot of both public and private health insurances, the challenge with the private players is that they're expensive, and some of these private insurance do not cover pregnancy-related expenses, especially in their early stages. So in these scenarios, household savings or wealth may act as a safeguard. We know that household wealth creation happens over a period of time, and it's a dynamic process. At any point of time, each household is given with certain amount of resources, and they a part of that they can use for consumption, and the other part is saved in different financial instruments. Some of them could be safe assets, and some of them could be risky financial assets. The household also can use some of its resources for healthcare production, and savings can thus be used to absorb not only the present health shock but also future health shocks. For example, Chiu found out that women who saved significantly had the higher chances of delivery in an institutional setup. So, given this backdrop, we try to understand the role of the savings and financial and portfolio choices by the household in protecting the mother and the newborn. So, with respect to literature review, there are several studies that have examined the pathways from wealth to health, especially healthcare access and healthcare expenditure. So, in one of the seminal works, Grossman 1972 and later extended by Jacobson 2000, both the authors showed that there exists a positive wealth effect on health. Later, Steinhardt 2009 showed that people with higher wealth status actually were likely to seek better healthcare than their counterparts in poorest wealth quintiles. Banerjee and Duflo 2008 showed a positive correlation between healthcare spending and standard of living. Avor 2011 and Arthur 2012 in their respective work showed how wealth has a positive effect on institutional delivery and ANC use. Guia, in a recent paper, showed that women who participated in microfinance in Bangladesh have actually used more healthcare facilities compared to those who didn't participate in microfinance. More recently, in 2020, Lee found out that ANC use remains disproportionately low among women in poor socioeconomic status households. So these papers have majorly examined that either wealth or savings, either through socioeconomic variables or wealth index by using some kind of physical assets, and examines their implications on healthcare uses. Some recent work, on the other hand, showed that the role of savings in healthcare demand. For instance, Dupas and Robinson conducted an experimental study and showed that even a simple savings can increase investment in preventive healthcare and reduces vulnerability to health shocks. Heckman 2019 showed how health savings accounts in US can actually health savings accounts in US are associated with reduced financial barriers to healthcare access. Therefore, we argue that financial savings and portfolio choice could potentially impact healthcare demand by women, especially during their pregnancy and childbirth. So we'll explain the methodology later, but what we try to do is we exploit the differences in savings behavior and health-seeking practices across several districts in India, and use these variations to examine the effect of savings and portfolio diversification on health-seeking behavior of women in the reproductive age, which is 15 to 49 years of 49 years. So that is our sample group. So now the major challenge for this kind of an empirical exercise is lack of a single database which actually captures both these dimensions of savings as well as health-seeking behavior. There is no single database that is actually is available, at least in Indian context. So what we do is that we use two sets of data. Now, luckily, these data sets were collected in close proximity, and they kind of provide us a similar kind of distributions in terms of rural-urban sample. So all the savings information and portfolio information comes from the NSSO 70th round of data on data and investment, while the health-seeking behavior comes from the DLHS 4, right? And we consider the ever-bright sample for our analysis. So what are the major outcomes? So we'll talk about the financial variables later on, but let's focus on the health outcomes first. So we consider several indicators related to health-seeking practices by women, which includes pregnancy registration within the 12 weeks of pregnancy, then whether a woman sought any treatment due to health problem during pregnancy. We used three key variables of antenatal care, which is whether ANC was sought during the first trimester, whether the pregnant woman took at least 8 antenatal visits to the nearest healthcare facility, or took at least 100 IFA tablets. Then we considered three variables regarding the institutional delivery. So first one is whether institutional delivery was opted. The other one is whether the delivery happened in a private institution. And the next one is whether the delivery happened in a public institution. With respect to postnatal care, again, we consider two variables. One is whether any postnatal checkup was considered after 24 hours of delivery, and whether this checkup happened in a private institutional setup. We considered several individual level control variables, which include age, women's schooling, husband's schooling, employment status, socio-religious categories. Again, whether any member of the household was diagnosed for a chronic disease. This captures the health aspect of the household. Then we also included some of the wealth indicators, right? Okay, whether ownership of house, land, and wealth. Now, because this data set is something which is not exactly where we can include the variables related to savings on an individual basis, we need to construct district level variables for the financial variables, and we also therefore include some of these district level covariates for our analysis, which includes district-wise proportion of people having health insurance, how far the nearest health facilities from the village, and district-wise proportion of financial assistance, right? Like, for example, JSY. And to capture the financial access, we included number of bank branches in an individual district. So, what are the financial variables we included in our analysis? So there are two things that we considered. One is savings, and the other is the portfolio diversification. So if you look at the NSSO 17th round of data, we find that the survey includes data on several financial assets, which includes some which you consider some of them to be safe, right? Government deposits in national savings certificates, Kisan Vikas Patras, savings bonds, post office savings, simple bank deposits, or like some kind of insurance, provident funds. All these we consider to be included as the safe asset class. On the other hand, the risky assets, for that matter, included whether households owned any shares and debentures in financial or non-performing financial companies. And we can see that the 7% household in the entire dataset had some kind of holding in risky assets. So how we define these variables? So the first exercise is that we consider that, okay, whether any household from the NSSO round had any kind of savings or not, right? So we consider two binary variable: one, if the household had some form of savings, or zero otherwise. And then if the household had both safe and risky assets, then that was counted to be the indicator of portfolio diversification. Now, given that these variables were considered at the individual level, but we cannot merge the data from the NSSO round onto an individual basis with the DLHS data, what we need to consider that we need to create a multi-level data set, right? So the multi-level data set in the form of the individual covariates related to the health practices, and then we consider, okay, where those individuals lived with respect to districts, and what was the distribution of these financial variables in a particular district. So we have to create a proportion of savings and proportion of portfolio diversification. And because our empirical method is something which is related to the treatment and control group analysis, we created binary indicators where high savers were those people who had higher proportion of savings than the average district-wise savings. So we had some districts which were high savers, and they were classified as treatment group, and the low savers were classified as the control group. Similarly, we did the same exercise with the portfolio diversification. So we had highly portfolio diversified districts and low diversified portfolio districts. So if we look at some of the summary statistics, we can see that nearly 80% of women and we created two samples. One is the full sample where one considers the savings sample, and the other is the diversified sample, right? So portfolio diversification. So nearly same amount of women were registered in both the samples, 81% for the full sample and 83% for the diversification sample. Then 27% women sought treatment during their pregnancy. 80%, almost 80% women sought antenatal care during their first trimester. 23% had full 8 ANC visits. 42% had taken at least 100 IFA tablets. Then 83% opted for institutional delivery, out of which 31% opted delivery in a private institution, whereas 52% had delivered in public institutions. Whereas we can look at that 35% for the diversified sample, it was had the delivery in a private setup. Again, with respect to postnatal care, we can see that 69% women had their postnatal checkup after 24 hours of delivery, and 26% women had those checkups in a private facility. The average age of women was around 26.5 years. Then 18% women had some kind of employment, 62% belonged to rural, 70% Hindu, 39% had were below BPL. And we can see that the proportion of people who had, like, 25% went for households had some kind of a chronic illness that were diagnosed for. 85% had ownership of households. 38% had owned land. And again, we can see that similar distributions can be observed with respect to district level variables as well. So if we look at the distribution, overall distribution, this maps are actually going to provide us the distribution of savings and some of the health variable indicators. So if we look at if it is blue or deep blue, then it indicates higher level of both savings as well as proportion of people, women taking antenatal and antenatal care during their first semester. So you can see that overall the districts where the savings were higher, the proportion of people who had savings were higher are districts which can be associated with higher levels of women seeking their antenatal treatment in antenatal care during their first trimester. Similar observations can be, we can see that institutions levels were higher in those districts where the savings were also higher. Similarly, for postnatal checkup, again, the distribution was kind of similar. So this gives us some idea that probably, if you look at the overall distribution of some of these health-seeking practices and their association with savings, we can find out that probably they indicate that there could be some relationship. So this motivated us to empirically look at, okay, what could be the role of savings and portfolio diversification on these health-seeking practices. Now, given that we have what we have, we do not have a data set where we can do this analysis at the individual level. We had to come up with a strategy to actually do this empirical analysis. So before we go into our actual empirical analysis, we wanted to see that, okay, whether empirically if we have two sets of sample, then if there is a difference that we can see among these variables with respect to high savers and low savers, and high portfolio diversification and low diversification. Right? So we have two treatment and control groups. So whether the treatment group had a higher percentage of people and whether these differences were statistically different. So we can see that obviously for pregnancy registration that there is a statistical difference between high savers and low savers, but there is no such difference between the highly portfolio diversified and low portfolio diversified. On the other hand, if you look at the prenatal or antenatal cares, then for all the three variables, we see that there exists statistical difference between the treatment group and the control group for savings variable, as well as for the diversified treatment and control group, except for the antenatal care, at least 8 antenatal care. Similarly, if we look at institutional delivery, we see that there exists difference between these two groups with respect to institutional delivery and private delivery. If you look at the postnatal care, again, we can see that there exists difference, right? So again, so a simple sample t-test gives us some idea that, okay, there could be a association between savings as well as post-portfolio diversification in these variables. So as I've mentioned that okay, because we do not have a data which we can actually see that, okay, whether at the household level or the individual level, what we rely on is a methodology which we can think about to be similar to cluster random trial, right? So cluster random trial is you can think this to be a randomized experiment where the randomization is happening at the cluster level, right? So if we are considering this to be a multi-level data, so we have individual level data and we have district level data. So the clustering is happening at the district level, right? At the second level of data. And we apply a matching algorithm where we can match based on this second level of data where the matching happens at the district level. So this method is called an optimal matching algorithm, which is the recently developed algorithm by Pimentel, Zubi, Zartera, and Klee. So what they basically is that, okay, because the randomization is happening at the second level of data, the matching happens first at the district level, and based on those belonging to treatment group and the control group on those districts, again, the matching happens at the individual level. So there are two levels of matching that are happening in these cases. So So we consider, as I mentioned earlier, we consider two such cases. One is where we're considering the districts with average savings, which are high savers, as a treatment group, and see that, okay, what are the implications of if the women are belonging to these high savings districts, whether they are seeking more health care they are they are seeking better healthcare practices compared to those who are living in low saving districts. And similarly, if the women who are living in highly districts with high portfolio diversifications, whether those high portfolio diversification is actually helping them seeking enhanced health seeking practices. So for the first case, we have 27,282 observations, and in the second case, we have 20,519 observations. So once this is the matching is done, then what we do is we apply a multi-level regression with a random intercept and clustered at the district level. So the advantage of this kind of exercise is that in this case, if there is some imbalance that remains in some of these covariates, we can include them as a control variable and see the impact of these variables, the treatment variables, on a particular health variable. So the first step towards this matching is we have to see that whether there is any imbalance that remains after we apply the optimal matching algorithm. So we begin by analyzing the balance at the individual and the district level variable. This can be understood by looking at the standardized difference. So the standardized difference is the differences in mean divided by the standard deviation. And the general rule of thumb is that the matched standard difference should be less than 0.2, preferably 0.1. So we can look at that. If you carefully look at the standardized differences for both these cases, we will see that for most cases, the standard difference is less than 0.1 actually, at least for the individual variables for both the samples. But what happens is that the standardized difference is for the district level variables. District level variables is less than 1 for the first model, which is the savings model. But for portfolio diversification, we see that for the financial access variable, which is the district-wise number of bank branches, the difference doesn't change. So what we do, as I said earlier, that we use this variable as, once again, right, as a variable in our regression equation as a control variable, and then find out the treatment effect. So once we do that, we can see that the impact of HSAV and on PREG and treatment is not statistically significant for the high savings sample. However, we find that the impact of HSAV on the antenatal care during the first trimester, at least 8 ANC and IFA are positive and statistically significant. So these findings indicate that women belonging to high saving districts do take more ANC care, and if we look at the institutional delivery, we see that the treatment effect of institutional delivery is positive and significant. So they do take more institutional delivery compared to those who are in low savings district. However, if we look at the postnatal variables, then we see that, okay, although the coefficient for postnatal variable is positive and significant, but there is no evidence that they are considering it in a private facility. And combine this with the previous two, right, whether they shot this delivery in a private facility, again, the effect is not significant. So there is no such evidence that, okay, they are preferring private facilities compared to their counterparts in low savings districts. Now, if we carefully look at the impact of savings portfolio diversification, then we see that actually the effect becomes negative in case of registration and treatment, but positive for at least 8 antenatal care. And in fact, if we look at the institutional delivery and delivery in a private facility, we see that both the effects are positive. And even for the postnatal care, both of the effects are still again positive. So we can see from here that women who are living in districts with high portfolio diversification, they are seeking not only antenatal care, more antenatal care, but preferring institution delivery, that too in a private facility, as well as they are seeking more postnatal care. So overall, we can find that that high portfolio diversification actually is leading to better some of these better antenatal care practices, choices of institution delivery and private facilities, and we can find that they are also looking for more postnatal care, and the same is true for high savings group. And this happens even when we are controlling for financial access, controlling for access to healthcare facilities by way of having a variable which captures the distance, as well as social protections. So we can see that the households, if they are making better financial decisions, that is also leading to improved maternal health seeking practices. So we can see that if from the policy analysis, if we can focus on improving the improve the financial outcomes of the household, that will not only help in their financial aspects, but also that will help in improving some of the key health indicators which are challenging for a country like India. So that's all. So I'd be happy to take questions after the end of the third presentation.
Thank you for that, Debashish. That was a well-made presentation. Again, just like the previous one, you also kept the presentation on time. The takeaways are also like pretty good. That with increase in financial like savings, there is better chances of the households seeking better health care during pregnancy, as well as other health-related expenditure. So now that the two presentations are done, before we go to the third one, another reminder to the attendees as well as panelists that we'll have the Q&A session after the third presentation. There have already been quite a few questions that have come. We'll discuss them as and when we finish the third presentation. So just keep that in mind. Now we'll go to the third presentation. The paper shall talk about the various factors that influence the kind of portfolios Indian households hold. We have the team of Priya Rampal, Assistant Professor at the School of Business Studies in Sharda University, and Dr. Shreya Biswas, Assistant Professor at the Department of Economics and Finance in BITS, Hyderabad. The team is going to present their paper titled Socioeconomic Determinants of Household Investment Portfolio in India. Welcome, Shreya and Priya. The floor is all yours for the presentation.
Thanks, Rakshit. I'll just share my screen. Yeah, just a slide. Oh. Yeah, so I hope my screen is visible.
Yes.
Yeah, so good evening to all. So this is a joint work with Priya Rampal. So we will be talking about the socioeconomic determinants of household investment portfolio in the Indian context. So quickly, what is the motivation? So household finance basically looks at how households use investment instrument to achieve their economic objectives. This is a term that was coined by Campbell in 2006. And since then, we have seen a lot of papers which have tried to understand why households invest in a particular kind of instrument, what are the outcomes of such investment behavior, etc. So broadly, if we think about the kind of investment, so households would be investing in a set of physical assets and the other would be the financial assets, right? However, if we kind of look at the household portfolio in developed countries vis-a-vis the household portfolio in developing and emerging market economies, they look very, very different. So Badarenza et al. In 2019 actually kind of summarized that how, because of differences in financial institutions, then also the occupational profile as well as like income of individuals staying in developing economies, their portfolios look very, very different from that in advanced nations. So I would just like to highlight a couple of, we look at portfolio of households in emerging economies. So that is typically real estate and gold kind of dominate the portfolio of households in developing economies. Secondly, there is also very low proportion of households who invest in financial assets. And this is true even for wealthy families. And also another thing which is kind of different from
Shreya, there's some background noise to your present.
Just
to your present.
Is it better now?
There still seems to be some noise.
Just give me a second. Okay. Is it okay?
Yeah, this is slightly better.
Okay.
I think it's the fan. If you have a running fan, please switch off the fan.
Right. No, I think it is from the headphones. So I've just taken that out.
Yeah.
Awesome. Yeah. Okay. So another aspect which is kind of which kind of stands out is that we see that in developing economies, the mortgage borrowings are typically at an older age. So which is a little different from what we see in advanced nations. So in advanced nation, the mortgage borrowing typically happens at a younger age. Now coming to Indian context, so in India, RBI Household Finance Committee report in 2017 kind of exactly talks about these issues which are very, very atypical in the Indian context. So this is directly out of the report. So what they find was that average Indian household kind of holds 84% of its wealth in real estate and other physical assets, 11% in gold, and a mere 5% in financial assets. Right? And even though the holdings of real estate is very high, mortgage penetration is very, very low, especially in early life. So this is kind of mirrors of what is in general the kind of trend that one observes in the context of developing countries. So coming to other features in the context of Indian household finance landscape, that is ownership of bank account is still below desirable levels, and also insurance penetration is also relatively low. So when we specifically look at low-income households in India, so they primarily depend upon informal sources of income because they are employed in the informal sector essentially. And among them, again, when we look at the agricultural household, they have additional risks in terms of weather shocks. So this kind of tells us that the Indian households are much more vulnerable given their occupational profile itself. So what has been seen is that these households often follow informal risk management strategies such as income and consumption smoothing, which is kind of inefficient and at the same time costly because it is related to giving up some lucrative opportunities. And also, if we think about the asset portfolio of rural households, they would be typically dominated by illiquid and non-tradable assets such as land and house. So given this premise, what is that we try to understand as a part of this study is that we want to understand whether low-income households kind of invest according to any specific goals. So whether at all low-income households have any kind of investment goals and whether their portfolio kind of reflects the goals that they have. Second, we look at what are the other socioeconomic factors that can kind of explain the investment behavior of low-income households in India. And finally, we also examine whether these factors vary across rural and urban poor or they are more or less similar. So coming to some of the studies that have already looked at household portfolios, I'll just very briefly talk about a couple of studies in the context of advanced economies and then a couple of studies in the context of developing economies. So as I mentioned that there is a huge literature on household finance. So even in developed nations, so Cardack and Wilkins 2009 study is based on Australia. So for Australia, what they found was that home ownership, financial awareness, as well as age of the household members kind of influence the risky asset holdings of the household. On the other hand, DeMock et al. 2016, in the context of US, actually find that ambiguity aversion is one of the reason why we kind of observe very low participation in equity markets. So households do not kind of prefer uncertainty, and because of that, they kind of refrain from participating in equity markets. Nato Campbell et al. Found that even if households in advanced economies invest in risky assets, they tend to make costly mistakes. And here by costly mistakes, they look at that households have very, very undiversified portfolios. And secondly, whatever mistakes that households commit in the financial market, they do learn from those mistakes. However, they are very slow learners. So they learn very slowly and hence tend to repeat the investment mistakes that they have already committed in the past. And finally, also, it has been documented in various studies that financial literacy and education are kind of factors that improves financial behavior in the context of developed countries. So very quickly, when we look at the literature in developing countries or emerging market economies, broadly the results are similar to the extent that in the context of China, like Gao and Fogg figured that education, income, then household size, along with the occupational profile are some of the factors that affects the participation in equity markets. Further, in the context of India, actually, Sahu and Virmani found that demand for real financial asset kind of depends on real interest rate and income. And Badarinza et al. Paper in 2016 actually looks at the household portfolio in India. And what they find that is very similar to the observations of the RBI report, that not only Indian households invest in real estate and gold, but even at higher quintiles, what they've found is that investment in gold kind of falls, but that is compensated by an increase in investment in real estate. So even though like basically one aspect of physical asset investment is getting substituted by another. So that's what they find in their study. So coming to the data that we consider for this analysis. So we look at the Indian Human Development Survey, the second wave of the survey, which was conducted during 2011 and 12. So this is a nationally representative survey of over 40,000 households, and it covers 1420 villages and 1,042 urban towns. For the purpose of our study, what we consider is we only focus on low-income households in India. And to identify the low-income households, we use an objective criteria, even though this can be debated. So what we use is we consider whether the household owns a BPL card or not. So using this criteria, we have 14,358 households. And out of these 14,358 households, 10,710 are rural households and rest are from urban regions. Okay. Coming to the socioeconomic factors. So we consider socioeconomic factors including age, occupation, gender, then household size, number of children, number of adults, older adults above the age of 60 years, etc. So we will be talking about these factors in the coming slides. So what are the basic outcome variables that we track? So first we look at 5 asset classes. So one is real estate, then we look at gold. So the first two are reflecting or are the proxies of physical assets that we consider. Then we look at liquid financial assets. So by liquid financial asset, this would include bank accounts, shares, debentures, etc. Then we look at insurance and finally pension products, right? We also define something called as a portfolio. So unfortunately, the IHDS data does not give us the amount that the household invests in each of these asset classes. But the questionnaire simply asks whether the household has invested in gold or owns gold or not, whether the household has an account or not. So these are all binary outcomes. So hence, we are unable to kind of look at what is the share of each of these assets within the portfolio. So for us, the portfolio variable simply is given as the sum of these investment assets that are held by the household. So it could range between 0, that means a household that does not hold any of these 5 asset classes, and can go up till 5. So 5 would represent a household that holds all of these assets. So this table here gives us a snapshot. So these numbers are in percentage. So it's kind of not surprising that when we, there's a small typo here. So when we look at the real estate holdings, so 77% of the households have some kind of real estate. So here by real estate, we also include land, right? So hence, so for urban and rural, this is 73 and 78%. Sorry for this. Then when we look at insurance, so one thing that is worth noting from this table is when we look at securities, so these are the risky securities here. So the risky security holding is very, very low. And hence we kind of club this as a part of liquid financial asset for our analysis, right? Also, also when we look at pension products, so for pension products, what we find is that the pension holdings are greater when we look at urban households and is much lesser in rural households. So one possibility could be that in urban households, actually some of them could be working in the formal sector, and where as a part of your employment, you're already enrolled in some kind of pension scheme. So that could be one of the reasons there. Another interesting feature is that one would often think that there is a possibility that there is a very high correlation among these asset classes, but that is something that we really don't find from our data. So there is a positive correlation when we look at the asset classes, but it's not that a particular household, say, that owns land is very likely to also say have insurance or say invest in risky securities, right? So there is a correlation, but the correlation between these asset classes would be kind of modest. So we explored this further. So in terms of methodology, so first we look at a couple of non-parametric exploratory techniques to understand the data better. So we employ the cluster analysis and linear discriminant analysis. So cluster analysis allows us to identify households that have similar characteristics. Similarly, discriminant analysis also is a method that helps us in classifying the observation into groups using a set of explanatory variables. And finally, we also employ logit and multinomial logit model along with multivarious OLS in order to examine what are the determinants of individual asset holding as well as the portfolio. Okay, so first we kind of look at the data and try to understand in a univariate sense whether households have some kind of investment goal. So when we talk about investment goal for low-income households, we essentially look at three things here. First is, do they have some kind of marriage goal? Means are the households saving for marriage? Second, are the households trying to save for children's education? And finally, are the households planning for retirement? So first, what we do is we look at the households that have at least one teenage female and compare it to households that do not have any teenage female. So the idea behind looking at teenage daughters would be because teenage daughters would be maybe like entering the marriageable age soon, and hence given customs associated with marriage in Indian communities, there is a possibility that these households are likely to hold higher proportion of gold, right? So this particular graph 1A kind of tells us that these are the households. So the orange ones are the households that have at least one teenage female. So these are the households that have a higher proportion of gold. Also higher proportion of such households have some kind of land or other real estate investments. At the same time, they are also more likely to have liquid financial assets. Similarly, then we try to kind of understand that how does the portfolio on an average look for households that have young children vis-a-vis households that do not have any young children. So what we do here is we split the sample and look at the investment assets for households that have at least one child below 14 years, then those that do not have any children below 14 years. But here when we look at their assets, so we kind of see that, okay, the households that have at least one child below 14 years, they have slightly more, slightly higher proportion of such households have risk-free investments. And similarly, they tend to have higher investment in real estate, but nothing so stark that we observe when we look at these graphs here. Then we also look at whether the investment assets kind of vary across the gender of the household head and also the highest adult education. So what we observe from these two graphs is when we look at female headed households, so the female headed households are the orange bars here. So they kind of tend to maybe do slightly, so they stand out as more vulnerable compared to male-headed households. But again, something that we cannot be very sure of at this juncture, but this is like the first feel that we get. Finally, when we look at educational attainment, so what we do is we look at least 10 years of schooling or more, and we say that these are the households that have some level of education, and the others that where the highest adult education is below 10 years. So again, here what we see is that the only difference comes in terms of, we do not see any difference in terms of real estate holdings. So we do not really see that education here seems to have any kind of direct correlation with real estate investments. However, for insurance holding, investments in risk-free asset as well as pension product, we see that higher proportion of such households with higher adult education are likely to invest in financial assets. So which would be also what our common sense would tell us. So now I would like Priya to talk about the results of the exploratory analysis and regression.
Thank you, Shreya. First we start analyzing using non-parametric ways. So here we have the cluster analysis and the discriminant analysis. So as Shreya already mentioned, that the cluster analysis is a classification technique, and we are trying to identify groups with similar characteristics. So we were able to create 4 groups using K-means clustering analysis. We found that the first group has a higher share of insurance, liquid financial assets, pension products, and a relatively lesser share of households have real estate investment. So possibly this is the group which is also having higher income and more assets on average, and education. Plus it is the group which resides in the urban region and has more social networks. So we see already that the non-parametric way is telling us that social connections, in addition to affordability and education, could be very important factors in determining the household's investment portfolio. Can we go to the next slide? So yes.
We have like around 8 more minutes left. So if you can.
Yeah. Okay. I'll probably take 10 more. So yeah. So this is the classification of the 4 groups. So the 4th group, as you see, is essentially they are the ones who are poorer with lesser educational attainment and having less connection on an average. Next slide. So next we employ the discriminant analysis to understand which socioeconomic factors help us to discriminate between different types of household portfolios. So here we first started with 3 asset classes: gold, real estate, and financial assets. But then we found that only 1% of the households hold only gold or gold and real estate. So therefore we reclassified this and considered physical assets, which includes gold and real estate, and financial assets as the 2 categories. So this figure here now shows a more balanced ownership between the 4. Next slide. So here, when we say 1, 2, 3, 4, we've actually made the portfolio such that the first is only the physical, having physical investment. Second is one which has financial investment. Then third, which do not have any investment. And the 4th, which has both. So essentially from the 2 asset classes, we created these 4, and we also found that there was significance in the discriminant function that we have. Next slide. So these are results from a regression to assess the determinants of investment in various assets at the household level. We first ran a probit regression where we clustered the errors at the village or the town level. So these are the important findings from that particular regression. The affordability appears to be a major factor that affects asset holding. So we looked at affordability in 2 ways. First, we looked at it as wealth, and the second as per capita income. So wealth in some sense is a stock variable, and per capita income becomes a flow variable. So we observe that higher wealth is related to a higher likelihood of holding real estate, gold, liquid financial assets, insurance, and pension products. Per capita income is positively related to owning gold, liquid financial assets, and pension products. Interestingly, we also find that as per capita income increases, low-income households are less likely to invest in real estate. So this may indicate a substitution from illiquid physical assets to more liquid financial assets as income increases. So our results for insurance were insignificant, which is in contrast to a finding by Badarinza et al. In 2016, wherein they find that as wealth increases, real estate holdings would also go up and insurance would also go up. Next slide. So then we focused on education and found that the highest adult education in the household increases the likelihood of holding investment assets, both physical and financial. And so this also means that educational attainment is actually a crucial mechanism which may improve the investment behavior for the low-income households in India. For example, a household with an adult having 10 years of education, they are 6 percentage points more likely than a household without any educated adult to invest in liquid financial assets. Social network is something which we find is significant. So it is a variable which is actually looking at the sum of connections of the household with educated people, or doctors, healthcare workers, and so on. So we also find that households that are more connected are more likely to invest in various asset classes. So in terms of demography, we've already discussed it by the graph. So we also found that in our regression results that older household heads are more likely to have real investment in real estate investment, and investment in home happens at a later stage in developing countries as compared to developed countries, and we found that too. Further, a household which has older adults, there is also a higher chance that they invest more in pension products or liquid financial assets. So for gold, we've discussed this, and the results were similar to what we found in the non-parametric approach. So we can go to the next slide. So amongst other factors, we found that a household that had experienced health shocks in the last 5 to 7 years was more likely to invest, which means that as if we were discussing during the literature review, that a household actually learns from its past mistakes. This is not true only for insurance, but for all other investment options it holds true. Female-headed households also exhibit similar investment assets as male households. Muslim households were less likely to invest in insurance due to their religious beliefs. Urban households and households belonging to scheduled castes have lower real estate holdings. Then another important factor that we found out was the confidence in financial institutions. So a lower confidence in financial institutions reduces the likelihood of holding liquid financial assets. So improving these institutions or the perception of individuals is very important, is an important means also to change their portfolio or encourage them to invest, and therefore break out of the low income trap. So you already discussed these results. These are the tables for the results. So we can go to the next slide. So what we discussed so far was a consolidated result, but we also ran individual regressions for rural and urban sector. This is because we found that real estate ownership was higher in the rural area. So we decided to run the regression separately. Per capita income, social network, and education largely had similar relationships in both rural and urban areas. And the gold part, where the relationship between teenage daughters and gold was mostly driven by the rural households, and so was the change in investment due to any shocks faced. So we also looked at socioeconomic factors, how they are related to portfolio composition at the household level. Now, in the absence of information, as Shreya has already discussed, we simply considered the number of assets in which a particular household invests. So our underlying assumption was that as the number of investment assets increases, the unsystematic risk of the household portfolio will fall and the diversification benefit would be higher. So our portfolio score is the standardized value of the sum of the assets at the household level. It is an imperfect measure of diversification, but given the limitations with our data set, it serves as a decent proxy for that. So we can go to the next slide. We found that social networks, education were the important factors, and they were significant in this regression as well. So we, in the end, we also did a multinomial logic regression framework, and we categorized it as the household investing in none, 1, 2, 3, or 4 or more investment assets. So no investment was considered as the base category. And here we found that female-headed households are less likely to hold more number of assets, and so are the urban poor. Higher income, wealth, social connections, and more years of education are related to a higher likelihood of investing more in assets. So both the OLS and the multinomial logic both suggest that affordability, education, and social network are important predictors of a diversified household portfolio of low-income households. So our last part is the discussion and conclusion. So we find that income and wealth remain the most important factors affecting the investment behavior of households. And this could be a major deterrent for low participation of low-income households. So therefore, designing affordable investment products, especially pension products, and well-designed micro-insurance product could be the key to improve the financial well-being of low-income households. Another thing that we found significant in most of our regressions was that marriage for many households, for households which have teenage daughters, is an important goal. And so one means to reduce the gold holdings at the household level would be to address the marriage norms in the Indian communities. So interventions to reduce dowry practices could be one way to improve the household portfolio. Higher education also improves financial behavior of low-income households. So policies directed towards improving education of the poor would generate positive spillover effects, along with diversification benefits. Households with more connections are also likely to invest in a diversified portfolio. So improving financial wellness, awareness of households which have more connections could possibly percolate to other households. So this could happen through peer effect. And in case this happens, then the cost of holding regular financial literacy workshops can be reduced. So if we can identify such people in the community who have more networks, then things could percolate much faster. Investing liquid financial asset portfolio with a higher average return with low transaction costs can also help the low-income household to break out of the income and asset poverty trap. So customized products are needed, which suit the needs of the low-income household, and interventions are needed to nudge them to correct their investment mistakes and invest in more lucrative assets, which would help them break the poverty cycle. Thank you.
Yeah. Thank you, Shreya and Priya, for your presentation. So this was like very quantitative in nature, and like you covered most of the points and determinants that we can think of. So now that we are done with all the three presentations, we can, I think, now go on to the Q&A. We have quite a few questions for all the three of for all the three teams. I'll just go over one by one, and maybe we can have the presenters respond to each of these questions. Yeah, okay. So the first question for Manish and Renuka is that gold seems to work as a good hedge against most assets from whatever you presented. However, most policymakers don't like gold. This is what I'm quoting from the question itself, and suggest conversion of gold into financial assets. Given this, what suggestions do the authors have for policymakers on gold?
Okay, thanks, Rakshit. I think one of the first things that we would say is, before we design, so it's true that gold is an unprotective asset if you look at it from the point of view of the economy. It is better if household savings are in financial assets, because that's important, because it becomes a source of capital for firms. I think the point that we are trying to make in this paper is, why is it that households are investing in gold? And if we want to lure them away from gold, then we need to understand how gold is performing as an asset class. And what I would say is that policymakers should worry about these underlying conditions, such as high inflation, such as financial repression, such as capital controls. And when you kind of align the policy along these lines, perhaps the economic rationale for having gold will go down, and people will see gold with on par with other assets, or perhaps gold will behave more normally in India as it does in international markets, where over a 100-year period real returns of gold have actually been zero. So what we need to do is understand why gold is doing so well. What is it about the structure of our markets that makes gold do well? And of course, there are other socio-cultural reasons that can only change over time. But if we can at least get these economic reasons sorted out, perhaps some shift will happen automatically.
Got it. Okay. Another question for you. This was with respect to the relation between gold and Nifty that you talked about. So the question is, with FIIs having a major influence on the stock market, is there any correlation or linkage to the outflow of USD funds on account of sales by FIIs that will possibly weaken the Nifty and INR and hence increase the gold rate in INR terms? So that is the question that was asked.
So it's possible. We haven't explored that particular channel. And yes, I mean, the more depreciation there is, because we are taking the price in London, the price is not determined in India. Of course, returns will increase because the conversion from USD to INR will just help improve the returns that we are seeing on gold. But whether it is a specific channel from the FII sales, we have not considered it. If Manish has something more to add to this.
No, nothing. Yeah, we haven't considered that channel explicitly, so we cannot answer that right now.
Okay. So one more question regarding methodology itself we have for you is to get a better idea of optimal gold levels in the portfolio, that component that you had in your paper. The question is whether fixed income holding should also be taken as one of the factors. Fixed income holding should also be taken into account because more than 80% of Indian households do not have equity in their portfolio. So they're asking if even income holding should have been taken as a factor.
I mean, we do look at, in the paper, we do sort of look at fixed deposit rates. I assume that's what they mean. And we, as Manish mentioned in his presentation, we find that real interest rates on fixed deposits have been negative, actually. And so, it's true that many households will not have access to equity markets, but then what they are left with are fixed deposits and endowment insurance products. Both of them are giving us negative real returns. So vis-a-vis those asset classes, I would think that gold is actually performing far better than either a fixed deposit or an endowment insurance product.
Okay. So the next question for Shreya and Priya, this is, so in your summary statistics, your full sample and your diversified sample both show very similar and almost identical results. So how can you say they are different? Like, how did you consider the diversified sample and what parameters made them diversified from the actual full sample?
Yeah, I'm not sure whether I exactly understood the question. So there is no full sample and diversified sample are not really different. So the full sample essentially simply looks at all households when we talk about full sample, and then we split it based on rural and urban. And for full sample, we look at individually what are the determinants of, say, investment in gold, what are the determinants of investment in real estate, liquid financial assets. So 5 separate models for each of the asset classes. And then again, for the same full sample, we look at something called as a sixth variable, which is a portfolio variable. And that is simply the sum of the asset classes. So if a household does not hold any any of these assets, it would be at 0. And then if the household holds all of them, it would be 5. So this portfolio analysis was also performed for the full sample, not for any separate sample.
Only for the goals part, we looked at particular households, for instance, gold. And so there also we controlled for the variable for the full sample. So I am not sure if they want to ask whether we focused on low income households. So our full sample is actually for low income households.
Okay. So another question for you. So the question is about whether you consider Atal Pension Yojana under pension products. Although it's like a micro pension product, the questioner wants to just understand whether you consider that as well.
Okay, so no, the reason being this scheme is I think 2015, if I'm not wrong, Atal Pension Yojana, whereas our data is from IHDS, which is a 2011-12 survey. Hence, that does not really figure in our analysis.
Got it. So one question for Devashish and Reshmi. Your study suggests that savings behavior positively impacts women's health-seeking behavior. Would you attribute this to be like a causal finding, or is it just like correlation between savings and health behavior?
Yeah, hi. So this is, I mean, it's a difficult question to answer, right? So, given that we have controlled for, several parameters, so the methodology is actually, you can see this is a causal interpretation, right? So the regression methodology that we have applied is purely it establishes that causal relationship, and we have considered several control variables, right? That's why the matching comes into, right? Okay, we have matched the districts based on both individual and district level variables, and see that, okay, if we control for all the heterogeneities, both at the district level as well as individual level, and include variables which relates to financial access, health access, whether, right? So we control for wealth, we control for whether there is a health problem in the household, right? Whether there is access for healthcare, there is access to financial services, and then see if and whether the household is having any health insurance. So once you control for that, then in that case, whether saving, the problem here is that we cannot directly say whether you saved more, then that led to higher practices, right? So we cannot conclude that given the nature of the data, right? So that is something would be a primary survey would yield. But we can here from this conclude that, okay, if you are living in a district where people tend to save more, right, where or you are accessing diversified financial products, then you are going to tend to use more of these healthcare practices, right? So that's the argument that we are placing, right? Obviously, you cannot directly say that, okay, if I have more savings, then I am going to use more healthcare, better improved healthcare facilities, right? So that we cannot directly conclude, but that's a data limitation, and there is no such data available anywhere. Like, no survey in India has ever done this exercise. We have done some of these other empirical exercises, like like a fixed effort model, which is widely being used in economic literature now, right? To look at most of the development economics, like a lot of when there is a divergence of in terms of data, and they're trying to mix and match with different data sets. A lot of papers are using fixed effort models. So we did that exercise with that, and that's also is providing us a similar kind of.
Okay, thank you, Debashish, for that. We'll take just one final question before we stop. So this is for Priya and Shreya again. So you define social network in your paper and talk about how increased social network actually improves household welfare with spillover effects and all that. So the question is whether your definition of social network was already a part of the data, or is it something that you defined? And if it's something that you defined, how did you define a household which has more social network compared to a household which has less social network?
Okay, yeah. Thanks for the question. So actually, ISDS again has this module where they ask the households about their acquaintances. So whether they know doctors, whether they know like teachers, lawyers, etc. Within the community, and also outside the community. So we use these set of questions to assess the network of a particular household. So this is again a count measure essentially. So a household may say they do not know any doctor or any teacher. So in a village kind of setup, these could be so influential people, right? So using that, we construct the social network. So these are from the survey questions.
That answers. Thank you. So we'll wrap up the question and answer session. We have a few more questions, but I'll just carry those over to the panelists so that they can answer them through text in the meanwhile. So now we'll just wrap the session. We had 3 great presentations. So before we head on to the break, I'll just recap the broad takeaways. The broad takeaways from the 3 presentations were that gold acts as a good hedge against inflation, equity, currency on daily returns level, and has given real returns over a long period of time. And from the second paper, we learned that higher savings pushes households to seek better health care, including prenatal and postnatal care for pregnant women. And we also learned about the determinants of household portfolio decision making. And we found that households learn from their past mistakes, and regarding determinants, that income, wealth, education, social networks actually help household welfare. And we found also that urban poor households and female-headed households tend to be more financially vulnerable than other households. So with these are some of our takeaways from the presentation, and with one more expert discussion lined up next, we can take a short break now, grab a cup of coffee, and return back for the final session. Thank you. Welcome back to the final segment of the second day of the fifth Dvara Research Conference. We now have the final segment, that is the expert discussion on the theme of household portfolios. It's my pleasure to welcome two well-known and distinguished faces from the field of household finance, Ms. Monica Helen and Dr. Vimal Balasubramaniam. A brief introduction about both before we proceed. Monica Helen is a trusted personal finance writer, a speaker, household finance policy expert, and a best-selling author of Let's Talk Money. She's also an adjunct professor at the Indian Institute of Corporate Affairs, Ministry of Corporate Affairs think tank. She's a regular speaker on financial literacy, regulation, inclusion, and consumer issues in retail finance. She has a master's in economics from the Delhi School of Economics and a second master's in journalism studies from College of Cardiff at University of Wales. She has worked across various media organizations in India, including Mint, the Economic Times, and the Indian Express, and was editor of Outlook Money. She has run 4 successful TV series around personal finance in NDTV, Z, and Bloomberg India. Vimal Balasubramaniam is assistant professor, School of Economics and Finance at the Queen Mary University of London. Vimal holds a PhD from the University of Oxford. His research interests are in the field of household finance, asset pricing, and applied microeconomics. With that said, I shall hand it over to my colleague, Misha Sharma, who heads the household finance practice at Dvara Research, to moderate the discussion between them. Over to you, Misha.
Thank you so much, Rakshit. Hi, Vimal. Hi, Monica. Really nice to see you both. Welcome to the conference.
Hi, Misha. Thank you. Happy to be here.
Thank you for having us. Thank you again.
Thank you so much. So really, thank you so much for staying on for these 3 presentations. I hope it was useful to hear from the authors themselves, and hopefully any clarifying questions have been sorted. So, really the idea of this conversation is to reflect on the 3 research themes that have been presented and discuss some of the larger issues around household portfolios, the state of household finance, so to speak, right? So the way I've structured this conversation is that for the first 30 or 40 minutes, we will go through a set of questions that I have in mind for the 2 of you. And then after that, if there are any questions, either from the authors themselves who are listening into the Zoom conversation, as well as questions from the audience, we can take those up. So, so that's the plan for the next 40 minutes to 1 hour, Vimal and Monica. So with that, I'll jump into the first question. And Monica, this question is for you, and then I'll also come to you, Vimal, which is that, what are your opening remarks after having listened to these 3 presentations? Now we had a set of interesting presentations on household portfolios. We had one presentation that looked at the role of asset as a hedge against inflation, against equity markets. We looked at the factors influencing the composition of household portfolios. We looked at household characteristics that determine portfolios. Interestingly, we also looked at the welfare effects of access to and use of formal financial instruments. We saw in the presentation by Flame University that savings behavior positively impacts women's health-seeking behavior, and they are more likely to adopt institutional delivery. So really, we have a set of interesting and varied presentations on the larger topic itself of household portfolios. Having listened to these presentations, what are your key takeaways from these 3 presentations? Is there any overarching theme that has stood out for you? Monica, we'll start from you.
Thank you so much, Misha. Thank you. And excellent. I really sat through the entire set of presentations. Fascinating to see household finance get its place finally in the academic world. I think it's been a little bit like, the money which goes for male balding is far more than what goes for malaria. And I feel that a disproportionate amount of academic interest has been on the stock markets rather than on the behavior of households. And so I'm actually delighted to see this deep work coming out. And one of the things which really stood out, Misha, was that households are taking rational decisions. So whether you look at each of the three papers, in some way, the message to me is, given the circumstance of the household, the access issues, the education, the ability to do something, and especially the gold paper, is telling me that the demand side really does a very constrained optimization. And that has been documented very well with these papers. And I would actually like to see far more research on the supply side of the market. So policy actually has always talked about the problem being with the demand side, right? So we've said that uh, household behaviors is like this. Households are irrational. They invest in gold, but the gold paper has blown that myth away completely. So essentially, I like this deep work, but I would like far more work to happen on the supply side. And I have specific comments to make very quickly on each of the three papers. So Priya and Shreya's paper is pointing to a very interesting link between education and networks and investing in riskier assets. So not just the ability to have the money, but also as people get more educated, their ability to understand financial assets goes up. And I particularly liked the link between having faith in financial institutions and investing in those financial institutions. So that is a key piece which I think we have missed to a certain extent, that households don't come into invisible assets. So gold and real estate are real, but financial assets are invisible. So it's only this trust in the institutions which will trigger more investment. The one point where I'm thinking there's a contradiction between the gold paper and this paper, Priya and Shreya's paper, is that to me, gold is looking like a rational choice rather than just for marriage. So this is pretty much on Priya and Shreya's paper. Debashish and Rashmi, again, it's providing heft to the view that we need financialization of assets in India. We know what the stats are for gold and real estate. But a paper like this tells us that portfolio diversification and financial assets as well lead women to better decisions in their time of the maternity period. A couple of points. Health insurance does not typically cover maternity, whether it's a PSU or private sector. We are not talking of the government schemes which are largely free, like the ASHA workers and the others. But commercial health insurance does not cover maternity simply because it's a certain event. Insurance only covers uncertain events. So I don't think there's a link between insurance penetration and the ability of women to access this product. You have separate maternity covers, but they're extremely expensive. All right. And just a very small piece, and this is coming from my experience as editor, that across governments, if you get the map of India wrong, you get a legal notice. So please correct the map that you showed. It has a key part of the top of the country missing. No matter which government it is, this is illegal. So just please correct your map. I have earlier in my journey as a journalist got such a legal notice. So I'm very careful about depicting India's map. The last point is, it would be interesting to know what kind of products the women had, the women who actually went in for institutional delivery. And the third paper, Renuka and Manish, I'm riveted by this because I have personally always held that the Indian household is a rational entity. And if they're buying gold, there has to be a reason, and we have not found it. And through this paper, you have actually mapped this journey of the Indian investor over the years, because this investment in gold is suddenly looking very, very rational. It's also telling us that Indian women are very savvy money managers, because the Indian woman's fixation on gold has been, at least in policy, what I have understood, has been mocked at. But your paper, Renuka and Manish, so I'm so sorry, Manish, really blows that argument away. So it's been a rational decision for whatever reason. The question that I would want you to answer is that, is there merit in recommending a higher allocation to gold? Because your data seems to suggest that. And second is, what is explaining this drop from 63 to 3 for 1 percentage point in return? I mean, that is one part of the paper which is leaving me a little unsettled, because this is huge. From 63 rupees out of 100, I'm going to do 3 just because my target return has fallen by 1 percentage point. So I would like a little more on that. The gold returns you've taken for 10 years, World Gold Council has data from 1980, I think on a daily or a monthly basis, and I have personally looked at that data. So you have actually 40-year data for Indian gold, 10 gram rupees per 10 gram data. And I have also crunched some of this number, and I've tried to look at gold, Sensex, FT, PPF returns. And one of the interesting things that I found, that over a very long period, not 10 years, but say 20 years and even 30 years, if the household managed to lock into a fixed deposit or PPF at a time when interest rates were high, it may have been that inflation was very high at that time. But if they've locked in at 9 or 12% FT 5-year, then there's a dramatic change in what your end value may be of your corpus. So maybe you can look at the World Gold Council data. And as a last point, I think I can only urge more work to happen in this space, and so that we can design policy choices which take into account the unique place that the Indian households have, and maybe look a little more on the supply side, Misha.
Yeah. Thank you so much, Monica. One point that I was really curious to ask you, I just couldn't resist. As a personal finance expert, I was curious to know what your take is on Renuka and Manisha's finding that suggests a 63% allocation of one's wealth to gold. So I was really curious to hear from you on that.
That's right. And I mean, it was fascinating to see this 63% allocation to gold. And that is what I have flagged, that between a target 13% return and a 14% return, the allocation is shifting from 63 to 3. Yeah. And it's a variation which is too high, in my opinion, to shift a portfolio in that manner. And also, I would just like to see a longer data set for gold, because whatever the numbers that I have crunched on gold, it underperforms the Sensex over 40, 30, 20 years is data that I have seen myself. So according to me, yes, gold, of course, has a place in the portfolio. Inflation, liquidity, all of that is there. But I think we just need to see more long-term data on gold.
Yeah. Thank you, Monica. Vimal, the same question to you, but in terms of your opening remarks, just also wanted to ask you if you have any methodological feedback for each of the research teams, or generally in terms of some of the questions we've looked at on this theme of household portfolios.
Sure. Thank you so much for having me here. And I have to begin by saying I completely agree with the kind of questions that Monica has raised as in terms of insights from each of these papers. So I just wanted to take a step back and think a little more about, do we know enough about the demand side for crafting the supply side to be better? So over time, in the last 6 odd years, there is a growing body of evidence about what households are doing. And as Monica pointed out, we are realizing increasingly that households in India are taking very rational but constrained decisions and choices. Okay, so investing in real estate or gold, which may be frowned upon in a normative context that's unconstrained, is potentially something that is meaningful in the poor financial supply side environment that we live in. So on that count, I just want to think a little further about whether we have sufficient research to show us, have we mapped all the constraints that households are genuinely facing? And so if we want to improve their household financial decisions, it has to be about how can the supply side cater to understanding the constraints under which these households are optimizing. So let's take a simple example. with gold. It may well be the case that people think that gold as an asset is unproductive, but to an average Indian household, a woman, it is hardly unproductive because it hedges all sorts of states of the world for a woman that any other financial asset would typically not be able to do because of simple questions of intra-household bargaining between men and women, right? So if that becomes important, then the natural question I have for academic research is, do we know enough about women's economic preferences in India? Actually, we don't. We know very little about what their risk aversion, what their discount rates are, what their expectations in terms of what they want when they grow old look like, what are their bargaining power vis-a-vis the average Indian man within the household looks like. And all of this becomes important then if you want to start thinking about what is the constrained optimization that households are involved in, right? So that's point number one. And the second big point is, I always enjoy Monica's question of how can the supply side do better? It's not about pushing, I mean, we have to take something as a given. We can't say, look, I'm going to throw my hands up in the air because households are behaving weirdly. It's not my fault. Actually, no, as policymakers, as markets, we have to evolve to cater to the kind of households, the kind of people that we have. It is not about, throwing your hand up in the air. So in that sense, the question of investments and savings does not exist in isolation from insurance and credit. Okay, so what do I mean by that? Again, if we were to think about the extent of debt burden that households may have and the kind of health consequences that might potentially have. So I'm just linking this back to Debashish and Reshmi's paper to think about, right, okay, if I'm going to be saving, in what kind of credit constrained environment am I going to be saving? Right? And would that make a difference to thinking about health outcomes? And how does this affect women disproportionately compared to others in terms of maternal health or any other kind of health that women would in particular be vulnerable to in terms of risks? So then naturally the question, I mean, I was looking up on whether insurance contracts allow for pregnancy, and Monica clarified that immediately. The point is it doesn't. And then it opens up another dimension, right? Which is to say, if it's a patriarchal society, the extent to which households are willing to invest their savings into women's health when it comes to pregnancy, at least intuitively for me, seems like it would be far better than in general well-being for women. So, for example, postnatal welfare for women or mothers is something I'm interested in. And I want to understand, are households that are saving a lot more, investing a lot more in how women recover post-pregnancy? And that becomes an important question because there the choice is not confounded by the demand for an offspring within the family as well. So that would be something I think Debashish and Rashmi can shed light on, and that would be an important insight into understanding how women are constrained in these household environments. The third point, after that I'll come to your methodological suggestions, is I'm not I don't buy this argument that gold and real estate is a bad asset to invest in. It's just that we don't understand why households choose gold and real estate to begin with. So there are two components to this. And the first, and it's been very nicely argued across the three papers in saying, am I making short-term rational decisions vis-a-vis the investments that I hold? And one of the things that Priya and Shreya point out is low-income households, as their per capita income increases, the investment in real estate actually goes down, which is actually quite nice. I know it goes against the other findings. I'd be very keen to understand what it is, because one of the papers they cite is actually mine, where we find that there's a positive correlation between investment in real estate and the wealth levels within the household. So it would be great to get to the bottom of this and understand what's going on. But putting that aside, the most important question to ask for me here is the nature of intergenerational wealth transfer within the Indian context. So both gold and real estate have different intergenerational properties. So, for example, real estate, although the laws favor real estate to be handed over to daughters and sons as much in equal parts, oftentimes what you would find is at least anecdotally or with personal experiences with extended families and so on, you would find gold being handed over in a matrilineal fashion, and you would find real estate being handed over in a patrilineal fashion. So it goes to the sons and the daughters as opposed to any other way. So then do we need to then think about what the long-term consequences of these choices look like? So given ex ante, if I inherit a lot of real estate, holding that constant, do I invest more into real estate or do I go to gold? I mean, to financial assets, because then that can tell you about what the growth for low-income households would look like, right? Because there's like a pecking order. So if you're a poor household and you're going to get richer and richer, the first thing that you may choose to invest in to secure your livelihood and your residence for your children and future generations, you may choose to invest in real estate and gold, because that's like a different risk profile. And then after that, the next generation may perhaps want to diversify away and invest in other assets. We don't know much about the intergenerational nature of savings and investment using real estate and gold as instruments. And that becomes very important because they are extremely valuable assets to transfer wealth across generations. To the to the research methodology and design questions, I was completely blown away with Renuka and Manish's findings on gold as a potential rational asset to invest in for households. And I was also particularly taken aback by the instability in the estimates of the portfolio allocation. So there's actually a lot of good, well-known finance optimizers. So theoretical finance loves Markowitz mean variance optimization. Practical finance does a much better job of saying, right, that doesn't work because you get corner solutions. So mean variance optimization constantly throws up corner solutions where it says, invest everything in gold or invest everything in Nifty. Okay, and that's because when you are optimizing these in a simple linear context, what happens is some small instability in your variance or a slight change in variance can change your optimizer dramatically in terms of what is considered to be the lowest variance you can achieve for the given level of returns. So one of the things that I believe that can fix this, I mean, there are two things that one could do here. First, don't set the average return that you want to achieve and then ask what's the portfolio. Let's go back. The one thing we know from finance theory is to say, look, investors need to get as much return as they can for the least amount of risk that they hold in their portfolio. So if we were to start with that premise, then you just need to simply work with understanding at what different levels of risk aversion do you get different estimates of what the portfolio allocation between Nifty and gold ought to be. So there you don't need to fix the expected return ex ante. You can just take the sample expected return for gold and for Nifty from the data, and then you just work with that to estimate this. So reparameterize, just understanding at different levels of risk preferences, what would the portfolio allocation look like? The second thing is I want to draw a distinction between an inflation hedge and an inflation indexation. Okay, so when a return actually gives, when an asset gives you a return above inflation, you're basically indexed to inflation. So at no point are you going to have a real return that's likely to be negative. Now, part of the reason I'm saying this is it's going back to Monica's argument of I'm going to rephrase it's the economy stupid to it's the supply side stupid, because um, the 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 enormous levels of monopolistic decision making on the bond market, on government run banks that determine very fixed levels of interest rates on fixed deposit and so on and so forth, it doesn't allow market forces to sort of calibrate the bond market, the interest rates and yield curves to what the inflation looks like, because what the retail investors invest in as interest rates is not what the bond market says the interest rates ought to be. So that again is so for me, what is more interesting and important is the Nifty benchmark. I wouldn't worry so much about the fixed income benchmarks, because there's so many other things on the supply side that we can't account for. But at least on the Nifty, we know that the market works reasonably well in a decent environment, and therefore I can trust the market prices and returns that it provides. Now, inflation hedge. Does gold hedge inflation? When inflation goes up dramatically, the claim is that gold prices are also going up, and so that's the only way you would get positive realized returns on gold, right? The only thing that I am a little bit unsure of is whether there are two things that I want to look at. First, I would like to understand how much of a difference there is between a wholesale price and a retail price of gold in terms of what the household actually pays. And the second thing that I would like to understand is to what extent is this gold used in any economic transactions for the household that is not credit. So what do I mean by that? It doesn't matter if it is going to be inflation indexed unless households can actually use the asset towards a purpose, right? And the purpose in this case typically is always, I'm going to go pledge gold and get some liquidity in order to finance things. So why is that remarkably important? It's important because it may well be the case that the demand for gold is increasing simply because interest rates are rising in an environment where households are already constrained and they actually need secure, sort of verifiable assets that they can pledge and raise liquidity with. So the one channel that the authors should rule out is to say, irrespective of what the financial constraints household face, gold remains a meaningful asset in the portfolio. So the current optimization strategy is an unconstrained one because it doesn't take into account debt at any given point in time. And the need for debt needs to enter the space before you can actually claim that gold is actually a rational investable asset. On the other two papers, on Priya and Shreya's work, I have to say I was really happy to see the use of k-means and simple non-parametric approaches to finding sort of different types of portfolios and different types of reasons why people may be allocating their asset holdings in the way they do. One of the things that I am particularly worried about is the amount of variation that exists within low-income households. So as long as you're using the entire wealth distribution, I'm very comfortable with all of the analysis. And any analysis that has been conditioned on thinking about low-income households is fraught with challenges that's both measurement driven as well as inference driven. So measurement is because you don't get particularly useful measures of what the valuation for assets are on the poorer end of the distribution. And that becomes a challenge. And we know so little about how they use informal financial markets to begin with. Are there informal savings setups that they use? And so it would be important to clarify and qualify your findings in light of what you can see in the data. And in terms of Devashish and Rashmi's approach, I think it was very thoughtfully designed in understanding what the health choices ought to look like. My only concern there reflects what I was initially alluding to, which is I want to understand whether it is maternal health that they are investing in, or whether they're investing in their next generation by improving the health expenses, given that you're saving a lot more. Because if it's the latter, then the story is very different in terms of what's driving the willingness to spend on women's health. And if it's the former, then it's music to my ears, because that's what we need to see: a lot more investment into postnatal healthcare for women in India. That's it. These are the notes that I had jotted down. Um, I think we may have lost Misha, Monica.
It looks like that. So I will just respond to a couple of points while Misha gets back on the Zoom call. So one of the, you mentioned this point about gold being for girls and real estate being for boys. And there is a perfect world where the law defines what we do. And there is the real world where we all live, where it is traditions and behaviors which actually determine what assets get passed on. And you're absolutely right. Gold does go to the girls mainly, and their share of parental wealth, intergenerational transfer, does come in the way of gold and cash or the other sort of non-fixed real estate assets is her part of the father side of the family. And the male line does inherit the real estate. So just a small point here, a lot of policy recommendation, and we had one paper which said that we need to change the norms around dowry, and we should discourage gold being the asset for the girls, whereas that's a very good sort of motherhood statement. But I think we should be very careful before we design policy interventions without really thinking through that this was the way she was going to get any access to the father's wealth.
Absolutely.
So we need to be very careful. So we can have our own, ideas and what we believe in to say, well, dowry is bad. We are educated women. We think it's terrible. But consider the rest of India, 70% of India, where the only shot that the woman has to any asset is to the gold, which comes in the dowry. So not for a moment am I saying dowry is a good thing, but before we do policy interventions, we should just look at the evidence on the ground. Nisha, you're back.
So, I mean, if I could take off on what you're saying there, Monica, I think we have to go one step further in saying government or policy intervention need not necessarily be rationalized if researchers deem to find inconsistencies in human behavior in what we observe, because oftentimes you can actually make it worse by intervening. So just a simple example, I'm personally not a big fan of the gold bonds that's been floated, because now it becomes a financial asset. Now, who's going to gain the most? It's going to be the men in the household. And it's taken agency away from millions of women in terms of what their vehicle of financial asset was. Now, do we know anything at all about this? No, we don't. We have absolutely little we understand about this. Yeah, I agree with that.
Yeah, thank you so much, Vimal and Monica. Sorry, I lost internet, but back now. So Monica, I'm really glad you spoke about that research finding on the heavy proportion of gold for households who have teenage daughters and the sort of policy implication that Shreya and Priya's team were talking about. So, because one theme that we've learned yesterday from some of the sector experts is also that we are probably sometimes taking a leap of faith when we are seeing results and then, sort of designing policies around that. We have to be a little more humble about how much do we know and understand about households. So thank you for sharing that. That was something I did want to point out. Monica, I think you and Vimal both have spoken about some of the barriers, and you've sort of classified it as demand and supply. So I do want to talk about that one by one. And if I can start by the demand side barriers, right? And I don't really look at this as barriers, but more as demand side context. So, for example, one study that Shreya and Priya spoke about, which is the household characteristics that determine household portfolios. They saw that higher levels of wealth, income, better education, stronger social networks, etc., is where there is more likelihood of participation in formal financial markets. And these are the kinds of households who are more likely to diversify across different types of assets. Now, I feel like this definitely points to a pattern in the type of customer segments that gets left behind in the financial inclusion story, which is those who are low-income households or women, or those who are agricultural farmers residing in rural areas and so on. So, looking at these results from the perspective of a policymaker, what are the kinds of policies that should be devised in this context? Now, I'm asking this in the light of the fact that, government policies, so for example, Jan Dhan Yojana or the Atal Pension Yojana, they're kind of like one size fits all. There is a standard product and it's a mass rollout to everybody. However, we know from not just this research, but research that has been done by Vimal, as well as the one pointed in the Household Finance Committee report, that there are particular sets of people who are getting left out. So how do we address this problem, especially for the excluded segments? And what are the sort of policy interventions we can design for this group that's traditionally getting excluded?
Misha, you're speaking about people who are unable to even access a bank account. Is that what you're talking about?
Yes, Monica, that's what I'm talking about. But I think now bank account ownership is almost 90 to 95% if you look at the household level. So I'm talking about beyond bank account, right? The ownership of life insurance, pensions, retirement accounts, those are still low. And especially if we talk about Shreya and Priya's study, then they are talking about financial investments or investments in particular instruments like FD and risky products, right? So I'm not talking about bank account because now we've sort of made some good progress there, but beyond bank account, the participation in all other products are terribly low. So how should we think about that? What can we do to address that?
No, it's a really interesting question. And the three papers have proved that the Indian household essentially comes out as a rational entity who's taking the best decisions given the constraints. Right? They have complicated financial lives at the poor end, also very, very complicated lives, simply because there's so little and it is so unpredictable. So in that environment, they're still being able to do what they can, and they're coming across as rational. Now, if that were to be true, then I think the answer is staring at us in the face. That give them the products. It's a supply side problem. I cannot say this more often. You get them a product that they understand, they trust, and they find useful, and they will invest. Right? So no amount of education, no amount of financial literacy workshops, when you put people in a classroom and educate them, we have papers which show that it has very little value and it decays over time. So those things just don't work. And I feel afraid when I see policy recommendations saying financial literacy workshops, because it's just money down the drain. So money spent on general education, general nutrition, better livelihoods are the enabling factors for a place where a person can think about moving away from the traditional assets. That's the point at which the supply side has to come in with products institutions, regulatory mechanisms, complaint mechanisms that people can trust. So it is very strongly a supply side issue, Nisha.
Yeah, yeah. Thank you, Monica. Actually, that is a good segue for the other question I had to you, Vimal, which is that, just a continuation of the theme there, which is that if we look at the household portfolios and the state of household finances currently in terms of their participation, we have statistics like 1 in 5 households have a health insurance account, 1 in 4 households have a life insurance account. The participation in pensions account hovers around 10% for the last 7 years. This has not increased, and I'm quoting from the CMI data set here, which is based on some of the research that we've done. So Monica has already touched upon, what are some of the factors, and she is very strongly articulated that it's a supply side problem. So from your perspective, Vimal, and all the work that you've also done on the Household Finance Committee report, how would you classify this issue? In terms of the supply side issue, what are the reasons why we're not able to bridge this gap in spite of, I would say, close to 20 years of sustained effort on financial inclusion? In fact, India is said to be one of the most enabling countries where financial inclusion is sort of given the kind of place it deserves. Yet we're quite far lagging behind in comparison to other emerging economies. So how would you sort of further nuance the supply side problem?
So I would take this squarely back to the failure of government policy. And the problem is 20 years of enabling environment, the true, if I were to sort of hang my hat on any one thing that has been a true enabler of creating a true market-wide sort of reducing transaction costs, improving transparency and all of that, I'd use the payment system as an example. Okay, so use the payment system as an example to say what worked in that context. What worked was you created infrastructure. You created infrastructure that enabled lower costs. You created an environment where firms were competing with each other, where you add sort of a percentage of your transaction as the charge for payment systems disappeared once you improved the payment competition and competitiveness in that industry. So what happened after that? You had Paytm, you have PhonePe, you have enormous amounts of investment in reaching the last mile, making sure that people can, I mean, the use of the QR code to enable payments is so simple, but at the same time, the only reason it works is because trust was built into the system. People can address a concern relatively quickly compared to, say, what happens with pensions or any of the other products. How can we learn from what happened in that context? That's all I'm asking. Okay, UPI works. Now we just need to see what can regulatory policy what has it done to insurance? It has done nothing other than actually close the field to the existing players and kind of enable their wishful thinking that investing hundreds of crores into financial inclusion is sufficient. No, that's not how it's going to work. Or coming up with really what I personally think is a completely wasteful product like a COVID insurance, right? Like, no, you don't want COVID insurance. And just because COVID's affected the middle class India, and often most regulators are middle class India, they think that's what we need. The truth is, if you really want a particular health ailment insurance, then you think about malaria insurance. Why would you not do that? Because it's so systematic. Similarly, why would you ever come up with a COVID insurance contract? Right? So regulators should stop creating products. They need to create an environment where firms have the incentive to go find out what household demand looks like and generate those products. We don't have that environment in the debt market, in insurance markets. We have it to some extent in the securities market. And so you can see that that's working all right. You can see that the payment system is working all right and is improving over time very well. Can we just transport all of those lessons in terms of what should policy do? It's not about being prescriptive. It's about enabling an ecosystem where markets can innovate to cater to household demand.
So thanks, Vimal. So you're saying that currently we're not at that place where markets are being able to sort of innovate, and there are these regulatory barriers that are stalling the financial service providers to innovate further.
Yes. So, I mean, don't don't get me wrong when I say that payments it's not a glowing example. There are lots of issues with payments also, but I'm saying the basic minimum we got right. We got the basic foundations just right, and we need to learn there is a balance between economies of scale and market forces delivering that economies of scale, where you see so the telecom industry is again a very good example. You saw suddenly there was a huge number of proliferation of number of telecom companies, and over time you saw that this kind of consolidated into an equilibrium where you have a few players but the prices are low and so on and so forth, right? Now again, you need to enable markets, at least that's what I would think, and we don't do that with our regulatory policies at the moment.
Thanks, Vimal. So we're running short of time, but I would like to ask one question on COVID to you, Monica. And, this is in relation to what are some of the trends that we're seeing in household portfolios now post-COVID. So based on some of the latest estimates from CMI, actually, we're seeing that there is a decrease in the uptake and renewal of financial assets such as fixed deposit accounts, health insurance, life insurance, and even pension accounts. So, one question on this is that what can the government do to ensure that years of work on financial inclusion does not get undone? Because now with the impact of COVID on households' income and livelihoods, households are not able to save and invest and sort of take up risk mitigating products as desired. One of the other questions actually, Monica, we've got from the audience is that do we expect COVID and a year in intermittent lockdowns to have any long-term changes in household portfolio structures? And does this shock push household into risk-averse tendencies? So a similar theme there, and your thoughts?
Yeah, no, it's a really important question because this is what we are seeing. So the rich, in fact, are getting richer when you look at the stock markets and the way that demat accounts and brokerage accounts are being opened. But on the other side, we are looking at hemorrhage on pension products, insurance not getting renewed, and fixed deposits getting withdrawn. And this is possibly because people need the money. They need the money to eat, they need the money for rent. But once we are through COVID, and we will be in however many years it takes, the memory of needing money will never go away. So I would actually believe that the impetus for savings is going to be even more. The introduction to insurance has happened, and people are understanding that you need insurance. And my only sense of regret is that if we had a better insurance regulated industry and regulated policy, we may have been ready to take advantage of the literacy spread because of COVID on the need for something like health insurance. So I think the ground actually is very fertile for even more financial inclusion, because everyone knows that, my goodness, I need money. Anything can happen again. So I would imagine savings rates to go up, whether or not they go into completely risk-free assets or towards the market. I think we should be indifferent about that. We should not care if people are choosing fixed deposits or gold over the stock market. That really is an individual decision. But the fact that people will save more is a given. Once we recover from this shock, I expect to see a higher savings behavior.
Right. That's very promising, Monica, because the data that we have from CMI, at least in the short term, the 6 to 12 months, we're all seeing bad news all around us with regards to a renewal of insurance products. There was a news article as well around the national pension scheme where households are not renewing their accounts. So really promising to hear from you that this memory will not go away, and there will be a very strong need felt to save and sort of be resilient against shocks. So thank you so much, Monica, for that. We will wrap up with one last question, which I wanted to ask to the both of you, which is around, sort of scope for further research, right? And this question is to do specifically on this topic of household portfolios. And Vimal, you spoke about that a little, which is to say that we don't know enough about Indian households, what is the economic agency and intra-household bargaining power of women. So you spoke about some themes, but going from here, where do you think there are research gaps, especially on the topic of household portfolios? Just to summarize, more or less, we know what is the state of Indian household finance in terms of participation. Unfortunately, we don't know a lot about where they are allocating their money and why. What are the decisions and factors influencing that? So we have some idea of what Indian households' preferences are, but there is still sort of some research gap, and I think it's also to do with the gap in data sets and lack of data. So what are your thoughts on areas for future research for researchers like us?
Tough question, but I'm going to take a cue from what Monica has harped on very, very, very articulately in all her work so far. We need to improve the supply side. Anything that can be positive in terms of product design, in terms of understanding the role of competition, understanding IO, right? Industrial organization of insurance industry, industrial organization of banking and fixed deposits and loan provision and all of those things would be super value relevant to improving the life of an average household and definitely the life of a poor household. But I want to add to this something that has been bothering me a great deal, which is whenever we talk about surveys in India, oftentimes all of us are guilty of using the demographic characteristics and proxies of the head of the household, which happens to be a male, as proxies when we do estimates of any elasticity, any of these things. And for me, that is just not on. That's like the former head of the IMF said, uh, addressing 50% of the world population, that's women, as invisible in these regressions is not an okay approach to research. So going forward, I want to understand the cross-section of economic preferences that women have, the constraints that they face, understanding the role of a lot of these types of financial assets and the life of in the average life of a woman across the income distribution and wealth distribution is terribly important, and we have invested thus far, at least according to me, very little in it. So I think Debashish and Reshmi make a great first step forward in sort of assessing what the real economic outcome of improved savings at the household level looks like. But we need to understand a lot more on what happens with women and preferences that they have across the spectrum and their income. I mean, can you believe we don't have an income distribution for women in India? We're talking about really, really poor levels of data infrastructure, but we know nothing about what their constraints are and what the decision-making environment even looks like. So that's where I would invest a lot more if we were to think about household finance contributing to the Indian context.
Yeah. Thank you, Vimal. That's actually some great feedback for us at Dvara Research as well. So we've noted that carefully. Monica, same question to you. From your perspective, what would you say should be the priorities for research?
So here's an interesting idea. Most of the regulators, I think SEBI, IRD, and RBI, all of them are looking at something called a regulatory sandbox, in which, under controlled circumstances, they will allow companies to try out new products. It would be very interesting for researchers in this field to embed themselves with some of this work to see how it works. And you will get data firsthand as different products or different approaches are tried in the three different parts of the market. So anything to do with regulators is going to be tough, but I think it's worth the effort at an institutional level to give researchers access to these sandbox situations and partner them with the entrepreneurs who are trying to do new products. So that would be my simple wish for future research.
Yeah. Thank you, Monica. That's really helpful. So I think we're at the fag end of our discussion. I did want to ask from all the presenters who are present here, any sort of response that you wanted to give to Vimal and Monica based on the feedback and suggestions that they've made for your papers. Okay.
Yeah.
Sorry, Devashish, you were saying
Yeah.
something?
Thanks both Monica and Vimal. So we apologize for the map. But there was some problem issues with getting the data for those statistics that we don't have anything right. So
Sorry, just to plug in there, if you look for GIS data on Google Groups, it does a phenomenal job of giving you all the shapefiles, including the politically correct shapefiles for India.
Yeah.
So
I'm more concerned about you not getting a legal notice. That's all.
So don't publish the paper, Nisha, at this moment.
Yeah. Thank you, Devashish. In fact, that was also a comment we received from one of the audiences as well. So I'm sure you've taken note of that comment.
Yeah. And the second point that yes, we know that understand that health insurance is something which doesn't cover the pregnancy related variables. So actually that actually reinforces our findings more because now once we control for that, whether if we had someone who was diagnosed for chronic diseases and probably that member took health insurance. So if we control for those two things, and in that scenario, if we try again, as I said, this is a step towards understanding the dynamics of savings and health seeking practices. We do not have individual level data for savings. Right? So the only thing that we can infer here is that even when the social protection has been there, if somebody had insurance and probably that household faced certain kinds of difficulty with respect to some health shocks, even in that circumstances, probably this is something that if we had higher savings that probably they used, right? So probably this would be really another comment is that interesting, right? Whether can we differentiate between the outcome of the woman and the future generation, right? When the households are looking for the welfare of the household, like where I'm going to take care of not only the mother but also the newborn, right? That's what the postnatal care is. So there is some indication probably that if I have a diversified portfolio, if I analyze the results, that probably if I have high savings, I don't find both the indicators being significant. But if I have diversified portfolio, then probably I will take up more postnatal care. Right. So I mean, probably we need to emphasize this. We have not really emphasized these things in the paper. So after your comments, I think we will certainly put forward these comments as an contribution to our in this literature. So thank you, really appreciate it.
Thank you, Devashish. Vimal, we have one question from the audience. I think you spoke something about more research needed in the product design area, right? What are the kind of products that could work? So we have a question from Jaydeep Banerjee from Dvara Smart Goal, and he says, how do we move lens on data for correlation and analysis to what really are the real world enablers that help in appropriate product creation? So any thoughts on that?
So I think this is going to be controversial coming from a quant person. We need qualitative research. That's the only way you're going to map the two. Okay. I think the only way we will learn what products need to be created is borrowing from the marketing literature, borrowing from years, decades of work in product innovation and strategy and stuff that business schools typically do. And they do this by talking to people. Okay, so correlation is not going to be sufficient to creating those products. But the next natural step where a quant person can be engaged is what Monica was also alluding to, which is, can we come up with a simple design of a study that would tell us what the value addition looks like? What should be the price for that particular product? What should be the price point at which you can actually maximize the demand for that particular product? What would the revenue generation system look like? And how is that detrimental? Can we think about applying, proper consumer protection framework to these questions? So embedding researchers in the sandbox would actually do all of those things, right? But firms first need to come up with the product by actually talking to people. There's nothing else you can do.
Yeah. Thank you so much, Vimal and Monica. I think we'll just wrap up the discussion with that here. Really would like to thank you both once again for your time and patiently listening in to all the three research presentations and joining us for this discussion. I think we have a really a fresh set of perspectives on sort of the new areas of research with regards to household portfolios and what are the research gaps as well after having listened to these three presentations. So thank you so much. That was really insightful, and we've taken a lot of notes from the talk. So over to you now, Rakshit, to close the session.
Thank you, Misha, Vimal, and Monica. That was a splendid discussion. I personally loved how free-flowing and thought-provoking it was. Like, to close the session, like, one key takeaway for me was the consensus among the findings of all three papers that were presented, as well as the discussion that followed right now, was that the policymakers as well as FSPs should carefully try to avoid being paternalistic in their approach, but actually acknowledge the fact that low-income households make rational choices and actually focus more on understanding what those constraints are and work towards easing those constraints, as well as providing products that they can embrace even while muddling through these constraints. So at the end of day two, we're extremely delighted to have had the kind of papers that have been presented, as well as the quality of discussions that followed. But there's plenty more that awaits us all through this week. So to remind you all, tomorrow we come back for day 3 of the conference. It starts at 4 p.m., just like today and yesterday. We have 3 exciting sessions featuring celebrated and experienced experts on 3 diverse topics. We have one on migrants and COVID-19 pandemic, one on innovations in household finance, and of finance for the new to credit segment of customers. So hope to see you all back here tomorrow, and thank you and have a great evening. That's it for us.
Thank
you everyone.
Bye.
Thank you. Bye-bye.